Well, as bubble talk persists in the AI sector and the tech sector at large, venture capitalists have the difficult job of still trying to make long term bets and predicting the future 10 years out. The business of venture capital is also in a fascinating moment right now. And to talk about all of that, I want to bring on Nnamdi Okike, managing partner and co founder at 645 Ventures. Nnamdi, welcome to the show. It's great to have you here.
It's great to be here. Thanks for having me. Appreciate it.
So I want to talk to you a little bit about some data that I was reading a few months ago. PitchBook and the National Venture Capital Association, where I know you're a board member, they put out their quarterly report on funding data. And, look, we're in Q4. We're waiting for the Q4 report to come out. But at least as it relates to the first three quarters, I mean, one of the points that fascinated me is they said with respect to LPs and fundraising from venture capital firms, we are sort of trending towards what could be nearly a decade low. I wanted to get your sense on why that's the case right now. I mean, why are venture funds having so much trouble fundraising from their LPs?
Yeah, it's a great question. I think there's a few reasons. I think one is there's been a lack of distributions going back to LPs in the past couple of years. There's been fewer IPOs, fewer M&As, and obviously LPs have portfolio construction and they want to have a reasonable amount in venture, but not too high an amount in venture. So I think their portfolio construction is a little bit thrown off due to the lack of distributions. And I think that really means they can't put as much into funds. I think there's also been an increasing pace of fundraising by funds. And I think that is now kind of working itself out in the system in terms of how much capital LPs can put into funds. So I think there's a myriad of factors. I also think LPs are being thoughtful in terms of where they want to place bets and thoughtful in terms of what the returns of the asset classes are going to look like over time. And I think the previous vintages, especially the 21, 22 vintage, haven't been very stellar in terms of returns, which I think for some LPs has given them some pause.
Now, I just want to come back to that point you made about the pace having increasing for these venture funds. Why is it that the pace of these fundraising events is increasing if the total amount of capital that LPs are giving them is decreasing? How does that make any sense?
So I think you got to go back the past couple of years. So what you saw past 5-6 years is that the amount of time between funds became much shorter. This is right around 21, 22 timeframe. And so funds were being raised faster and more capital was going into the system. And I think if you look at those funds that were raised, say, 4 or 5 years ago, the returns have been lagging. There's very little DPI. I think the top quartile distribution to paid in ratio for funds raised in 21 is much less than 1x. It's, I think for even the best funds, it's maybe 25% of what they raised. So there's been very limited distributions, and you start to see that working itself out now in terms of LPs again saying, well, if we're not getting capital back from these funds, why should we be reinvesting or putting more money into these funds? And so, venture is a cyclical asset class. It does move in waves, and LPs need to see returns and distributions to have confidence that it's a great place to be putting capital into. And I think some of that is driving what you're seeing in terms of LP contributions this year.
And so we've seen IPOs pick up slightly. It's not the avalanche that people, I think, were hoping for. But I mean, they have been picking up. Now, we'll put the performance aside of these new companies that are going public. Is it not helping distributions at all? I mean, is the situation at all getting better, at least for LPs?
I think there's some light at the end of the tunnel. To your point, this year you've seen IPOs. So I do, primarily invest in fintech, and this year you've seen companies like Chime and Klarna and others. To your point, they haven't performed great post-IPO, but at least they provided liquidity to the GPs and the LPs invested in those funds. So that's a good thing. I think generally what you find if you look at private markets is that there's been an elongation of time from, say, first early investment from early stage venture, which is what we do. We invest at seed and Series A to exit. I think median period of time between initial investment or a company being founded and an IPO is now upwards of 13, 14 years for even the best companies. That's very different than what it might have looked like 15 years ago, where periods were much shorter. And you also have this kind of growth of late stage investment. So if you think about a company like Stripe, for example, how long they've been private and how high they're valued in the private markets. But again, haven't had the exit event. And so all of those things, again, impact the LP perspective in terms of their IRR. LPs think about both IRR as well as total value to paid in, total multiple, but you're just elongating the period of time in which you're investing, and that's something that LPs take into account.
Right. Now, I want to ask you about another data point from that report in October. Venture debt is at its highest level in quite a few years. What's the story around venture debt right now?
The venture debt market's always very interesting. We obviously saw the collapse of Silicon Valley Bank a couple of years ago, kind of largely driven by venture lending practices. The venture debt market is interesting. The way we think about it for our portfolio companies is it can be a complement to equity financing. It can enable companies to raise a bit more money. The venture capital funding, the equity funding is typically the backstop of venture debt. But I always get a little bit wary when venture debt, to your point, levels are very high, because venture debt is being provided to companies that typically aren't profitable, don't have positive cash flows, and are really relying on continual fundraising. So if, for example, take AI, right? If the fundraising market for AI companies drops or dries up somewhat over the next couple of years, those venture debt providers are going to be in tough shape in terms of those companies being able to raise more money from the equity markets.
Right.
And typically companies don't have a lot of physical, well, I guess in the case of maybe data center companies, they have assets, but most software companies don't have assets.
So you talk about getting weary when levels are too high. Are you weary right now?
I haven't looked at those multiples really closely, but the data point you're providing in terms of them being at, historical highs, that is a little bit concerning to me.
I mean, it's pacing to be the biggest year in 10 years. That's as far back as the report went, at least. So that's as far back as my notes go.
That is concerning to me, definitely.
Let's talk briefly about valuations. One of the things that I want to get a sense from you on as a student of the venture capital sector is everybody talks about valuations being high, and that is certainly a reflection of the competition for deals and everybody trying to go after the same deals.
Yes.
Mechanically, what has to change for those valuations to come down? When do you think the music, quote unquote, stops? I mean, the stock market is one thing, but is it waiting for the stock market to sort of translate into startup valuations? What tactically has to happen for competition for these deals to decrease?
That's a really good question. There's a couple of factors that drive valuations, especially at the early stages of venture, or even growth stage, right? The first is just the pure supply of capital. How much capital is competing for deals? It's a supply and demand question, right? So when there's a plethora of capital in the market, typically valuations go up. There's just more demand.
So suddenly, all the scarcity in LP fundraising, it starts to actually have an impact.
Yeah. So you over time, to your point, like you'll start to see the impact of less capital going into funds.
Yeah.
Less capital will go into companies, and that is one of the checks and balances of venture in terms of investing in valuation. I think the second thing is, how do the venture investors perceive the returns? So what you've seen in the past couple of years in AI is that there's been this race to invest in companies where the belief is that at the end of the day, the outcomes are going to be significantly large. And so you've seen historically large rounds getting done much earlier than historically was possible. So before co-founding our firm 645, I was a growth investor for about 8 years at Insight Partners. And historically, growth investing was very much based upon fundamentals of performance, quality of business model. Yes, growth, but also path to profitability, underlying margins, how good is your business, right? I think investors have gotten away from that a bit in this kind of period of time, especially for AI companies, where it's all about extremely rapid growth, but where the fundamentals of businesses are getting lost a bit or are just unknown. The reality is in AI, there's new business models being experimented with, but we don't really know per se what a great AI business looks like at the end of the day. We don't have the metrics in the underlying business quality that we might have for a traditional SaaS company or even a consumer company, right? And so I think the result will likely be that as things shake out, there'll be a flight to quality in terms of high quality business models.
Right.
But I do think
how quickly does that happen? Are we talking first half of 26?
I would say over the next 2 years.
Okay. Well,
I think you're I think you're starting to see a few of these things starting to take place. To your point about supply of capital, that's starting to manifest itself. I
right.
think the public markets sometimes are a signal. So if there were meaningful declines in valuations, now there aren't a lot of public AI companies, so it's harder to comp, right?
Right.
But if you saw, certain companies drop, so Nvidia is an example, or others, there might be a little bit of an effect on the private markets. But at the end of the day, typically it's based upon things starting to shake out in terms of business model quality. And I do think if you look at, again, some of these AI companies, how much they're raising and how fast they're raising, there has to be a shakeout because the multiples that are being applied to them are so extreme.
Yeah.
You're seeing companies raise at
some of
hundreds
them,
of times.
yeah, they don't even have revenue, let alone
Yeah.
products, some of them. So
see, we like to talk about revenue multiple, but in some cases there's no revenue. So there's no.
Yeah.
No
Well, how much is how many people you've managed to hire? That's, those multiples are also pretty crazy. Nnamdi, I want to thank you for coming on. It's a great conversation, and we certainly will be watching. We appreciate the time, and we'll talk to you again very soon.
Thanks for having me. Really enjoyed it. Thank you.